I'm Mike Bradner, and this is Capital Views, and we're talking with Angela Rodell, who's the Commissioner of Revenue, and she comes to the commissionership from Treasury, so you've been involved in, you have your hands on the state's money.
That's right. I was with the department for 2.5 years as the head of the Treasury Division before being promoted to commissioner.
And tell us, when we think of our funds which you manage, why don't you run through a laundry list of those funds that Revenue manages?
The Department of Revenue has fiduciary responsibility for over $50 billion of state revenue, and that is not the Permanent Fund Corporation. The Permanent Fund Corporation is separate and apart from this amount. And these amounts run the gamut from the general fund and other investments that we have. It includes the statutory budget reserve fund, which has a balance of about $4.5 billion right now. It includes over $10 billion attributable to the Constitutional Budget Reserve Fund, and it includes well in excess of $23 billion in the PERS and TERS retirement trust accounts. So there's quite a bit there.
Now, what's happening in the earnings of these funds?
Calendar year 2013 was a very good year in the market. The Dow Jones indice on equities was up over 25%, and so we've seen that reflected in all the funds.
I noticed it.
So we've seen that reflected in all the funds that have equity allocations, whether it's PERS and TERS, the CBRF, or even the Power Cost Equalization Fund.
So what kind of returns did they get, I mean, on different funds? I mean, some are long-term funds, some you have to manage for short-term purposes that you may require funds.
Right.
So
when we look at the general funds, obviously we need day-to-day liquidity, and so that's managed much differently than something like the Constitutional Budget Reserve Fund or the PERS and TERS trust funds. The general fund earned about 0.25% last year, and that was primarily due to the fact that short-term interest rates continued to be so low. On the other hand, when we look to the Constitutional Budget Reserve and its ability to expand its asset allocation, we were in something in excess of 7%. In the case of the PERS and TERS, we earned 12.5% to 12.6% on the PERS and TERS trust funds. So the value of having that asset allocation that can go into a number of different asset classes really benefited PERS and TERS over the last year.
now, PERS and TERS, those are long-term funds, so you can invest in a longer-term scenario. Now, we have a liability against our PERS and TERS programs. And let's see, the PERS is state employees and certain municipalities, and TERS is the teachers' fund.
That's right. So PERS is for Public Employees Retirement System, and TERS is the Teachers Retirement System. And we do have an unfunded liability, and at its last calculation, it was around $12 billion in shortfall, and that's really just a simple measure of assets versus expected liabilities to pay off.
Now, that resulted from first the dot-com collapse in the early 90s, and we moved and thought we had fixed a lot of that. Mm-hmm. And then along came 2008, and we got hit again. And everybody else, it was the same experience for everybody in almost every fund.
Correct, and it's not unique to Alaska as well. If you look at the public employee retirement funds for states across the country, all of them experienced significant losses in 2008-2009 timeframe, and it takes a long time to make those losses back up, especially when you were looking at 20% losses in those years in some cases.
You know, as I recall, in the late 90s, I remember in theory we were overfunded, and the TERS and TERS board actually was going to lower the rate, and it was a foot race for everybody to make an announcement that the cost would be less, and nobody anticipated what was going to happen right around the corner. But we weren't negligent in funding our programs.
No, I don't think so. I think what happens is that every year the actuary does a calculation and makes certain assumptions about what will happen in the future, not just in terms of the investment returns, but also in the experience of the beneficiaries when people will retire At what benefit levels will they retire at? What are the cost of living adjustments that need to be made? How many people get divorced? Spousal benefits? All of those things feed in to the calculation of the unfunded liability, and contributes to that. So when benefit costs go up, that also contributes in addition to investment losses.
And some of those are still under two different types of retirement. There's the older tiers that were guaranteed benefit, and then there were the guaranteed contribution, which has been in existence since 2006. How is the new program doing? I mean, when we say your investment in, the employees select what, a KEO kind of arrangement, and but we understand there's been a lot of drain out of that because people have left the state.
I think the defined contribution program continues to perform well, and when employees leave before they have vested into the defined contribution, they're only taking the portion that they themselves contributed out of their payroll. So I think that's an important distinction to make. But so far, we've expanded the investment options that the defined contribution members can select, and I think that that's been very helpful to them.
Sheila, we're out of time, and I'm Mike Bradner, and this has been Capital Views, and we've been talking with Angela Rodell, the Commissioner of Revenue.